Welcome to the Opening Bell Report.
104.73.
It creates a bit of a visceral reaction when you say it out loud like that, doesn't it?
It really does. I mean, it's a number that's been staring me in the face all morning. I was going through the pre-market data, looking at Hecla mining ticker HHL, and I genuinely thought my data feed was glitching. We're talking about a price-to-earnings ratio, a PE, of nearly 105.
Which, to put it mildly, is nosebleed territory.
Nosebleed. That's stratospheric. I mean, even in a bull market, even with the S&P 500 doing its thing, the averages, it's nowhere near that. And usually when you look at mining stocks, gold, silver, copper, you expect a discount. You expect them to trade at, 10 times earnings, maybe 15.
Right. Historically, miners are value stocks. They're not supposed to be priced like a tech unicorn from the dot-com era.
Exactly. My first instinct, and I'm pretty sure the instinct of almost anyone listening who sees 104x earnings, is to say, this is a bubble. This is insane. This stock is dangerously overpriced. It just screams, run for the hills.
And that is the rational knee-jerk reaction. If you just run a simple stock screener for value, Hecla looks absolutely radioactive right now. But that is exactly why we're doing this deep dive today. We've got a detailed analysis report in front of us, dated today, January 26, 2026, that argues that headline number is, well, it's lying to you.
So we're going to play detective here. Our mission is to figure out why the market, which is, generally pretty smart, is willing to pay such a massive premium for a silver miner. The report calls it a valuation anomaly. Sounds a little mysterious.
It does, but the argument is actually quite grounded. The core thesis here is that this 104x PE isn't a bubble. It's what the report calls a quality tax.
A quality tax. I like that phrasing. It sort of implies you're paying extra for the good stuff. Like buying the organic avocados instead of the rock-hard ones on sale.
Precisely. The argument is that sophisticated institutional investors are completely ignoring the PE ratio. They're looking right past the earnings line item on the income statement and focusing on two things that matter way more: cash flow and reserves.
Okay, I'm willing to hear the defense, but let's play devil's advocate for a minute. Buying anything at a 104 multiple feels like financial suicide. How do we justify that price tag? What is mechanically wrong with the earnings number that makes it so useless in this specific case?
To understand this, we have to put on our accountant hats. Just briefly, I promise. It all comes down to the massive gap between net income, which is an accounting figure, and actual cash in the bank. And in the mining industry, that gap can be the size of the Grand Canyon. The report calls this the depreciation distortion.
This is the DD&A stuff, right? Depreciation, depletion, and amortization. I always feel like my eyes glaze over when I hear those words, but it sounds like they're the villains of this story.
They're the villains of the income statement, certainly. Think about the business model of mining. You don't just, walk into a field and pick up silver bars off the grass.
If only it were that easy.
Right. You have to move mountains, literally. You build massive, complex infrastructure underground, mills, ventilation systems, safety structures. Hecla has been spending heavily on this, particularly with the ramp up at the Keno Hill mine in the Yukon.
And under GAAP accounting rules, the standard rules everyone has to follow, you can't just write all that cost off the day you spend it. You have to capitalize it.
Correct. You put it on the balance sheet, and then you depreciate it over years. So imagine Hecla spent $100 million 3 years ago to build a shaft. Today, they're mining silver out of that shaft. But on their income statement, they have to deduct a huge chunk of that old cost as a depreciation charge.
So every quarter, Hecla's income statement gets hit with this massive expense that isn't actually cash leaving the building today.
Exactly. It's a non-cash charge. It's like a memory of past spending. But it drags net income down, making the earnings look tiny. And here's the math trap. PE is price divided by earnings. If your earnings number is artificially smashed down by depreciation, your PE ratio mathematically just skyrockets.
So the E is tiny, which makes the multiple look huge. But, and this is the key, that money isn't leaving the bank account today. They can still use today's cash to, pay dividends or buy new drills.
Precisely. It makes the stock look expensive on paper, but it has zero impact on their ability to pay the electric bill today.
There's another layer to this low earnings puzzle that I found really interesting in the report. It's about how they handle exploration. Because Hecla isn't just sitting on what they have, they're, looking for more.
Yes, and this is a strategic choice that penalizes them on the scorecard, but rewards them in reality. Hecla is aggressively reinvesting money to find more silver. They're drilling constantly.
And the accounting rules are tricky here. If you're just exploring, just looking for new deposits, you often have to expense that cost immediately. You can't capitalize it like a building.
Right. So imagine this scenario. You spend $10 million today to find a silver deposit that you'll mine for the next 20 years. That 10 million hits your profit line right now. It just crushes your earnings for this quarter.
So by doing the responsible thing, by securing the future of the company, they are punishing their current PE ratio.
It's a paradox. If they stopped looking for silver tomorrow, their earnings would jump and their PE would drop. They'd look cheaper to a computer algorithm. But the company would be worth significantly less because it would be dying a slow death.
So the institutional investors, the hosts of the party, so to speak, they know this game. They know that net income in mining is a messy, distorted figure. So they throw it out.
They pivot entirely to OCF, operating cash flow.
Which brings us to the part of the report that actually made me stop and recalculate the math myself. We're calling this the bull case, but really it's about efficiency. The report calls it the cash flow conversion engine.
You're looking at that conversion percentage.
I am. The report states that Hekla is converting approximately 48% of its revenue into operating cash flow. 48%.
It is a staggering number.
Let's contextualize that for a second. In the broader industrial world, making cars, building washing machines, selling groceries, what's a normal conversion rate?
Oh, if you're a standard manufacturer, you are popping champagne corks if you hit 15 or 20%. A 20% margin is a great business. Most retail is in the single digits, getting near 50%. That puts you in the realm of like high-margin software companies or royalty businesses. It's almost unheard of for a company that actually moves rocks and crushes ore.
The report uses a great analogy to make this concrete. It says, for every dollar of silver Hekla sells,
they are pocketing nearly 50 cents of it as operating cash flow. Now, that is before they pay for capital expenditures, of course. But the raw efficiency of the operation is elite.
It's like owning a lemonade stand, but instead of spending 90 cents on lemons and sugar to sell a $1 cup, you're only spending 50 cents. You have this massive buffer.
And that explains why the analysis in the source material argues the PE is so misleading. If you just look at 104x earnings, you assume the business is barely scraping by, maybe operating on razor-thin margins. But when you look at the OCF margin, you realize it's actually a money-printing machine.
So the market sees this and says, I don't care what the accountants say about depreciation. Show me the cash.
Cash doesn't lie. And Hekla generates a mountain of it relative to its size.
Okay, so we've debunked the E in the PE ratio. It's distorted by depreciation and exploration, and we've established that the cash flow is world-class. But there's another reason for this premium, and this one feels a lot less mathematical. It's about the map.
Geography is destiny in mining.
The report calls this the safe haven premium. And looking at the dateline, January 2026, the world feels, well, shaky is putting it mildly.
It's a volatile backdrop. The report highlights this specifically. We're seeing a rise in resource nationalism. You look at South America, traditionally a mining powerhouse, and you have governments talking about nationalizing lithium and copper assets, changing tax codes overnight or, revoking permits.
It's terrifying for capital. I mean, put yourself in the shoes of a portfolio manager running a $1 billion fund. You've got $50 million tied up in a mine. If that mine is in a jurisdiction where the government might wake up tomorrow and just decide to seize the asset, you aren't sleeping well.
Capital is cowardly. And I don't mean that as an insult. It's a survival mechanism. When risks rise in those frontier jurisdictions, capital flees to safety. It looks for the rule of law. It looks for courts that work. It looks for stability.
And Hekla's portfolio is basically the poster child for safe jurisdictions.
They really are. They are the premier U.S. domiciled silver producer. Their flagship assets are right here in Idaho and Alaska. Greens Creek in Alaska is a tier 1 asset globally. And then they have the Lucky Friday mine in Idaho.
And the rest is in Canada, Yukon, and Quebec.
Exactly. You'd be hard-pressed to find a safer political map for a mining company. North America is the bunker everyone wants to be in right now.
So this premium, this quality tax part of it is literally an insurance policy.
That's a great way to put it. The report explains that investors have a lower cost of equity for Hekla. They're willing to accept a lower yield, which translates to a higher stock price, because the risk of total loss is virtually zero. They might pay 20 or 30 times earnings for a silver miner in a volatile country because they need to be compensated for the risk that the mine gets stolen.
But for Hekla, they'll pay 100 times earnings because they know the mine will still be there in 10 years. They're buying certainty in an uncertain world.
It's the sleep well at night premium. And in 2026, with the geopolitical headlines we're seeing, that premium is worth a lot. The market is essentially saying, we will pay up to not have to check the foreign news desk every morning.
So we have the cash flow engine and we have the safety premium. But the report mentions a third driver, and this one is all about timing. It talks about a supercycle and specifically how Hekla is positioned within it.
Yeah, this connects back to the growth profile. A stock price isn't just a snapshot of today, it's a bet on the future. And Hekla's future looks very different from its past.
We touched on Keno Hill earlier regarding the depreciation costs, how building it hurt their earnings on paper. But that story is shifting now, right? The building phase is done.
Yes, all that money they spent, it's sunk, it's in the ground. Now, in 2026, Keno Hill is ramping up into full commercial production. This is high-grade silver, and a lot of it.
So they are hitting a volume inflection point. They are pulling more ounces out of the ground exactly at the moment when silver prices are trending up.
It's the holy grail for a commodity stock. You want rising volume into rising prices. It creates a compounding effect on revenue. If you produce the same amount when prices go up, you make more money. If you produce more when prices go up, you make exponentially more money.
And the report highlights something else about their financial health that acts as rocket fuel for this: deleveraging.
This is critical. Over the last couple of years, Hecla has aggressively paid down debt. The report notes they've reduced net leverage from about 1.8x down to roughly 0.3x.
3x is basically nothing. I mean, they're almost debt-free.
And here is the insight. A debt-free balance sheet in a rising commodity environment triggers what we call multiple expansion.
Wait, let's unpack that. Why does having no debt make investors want to pay a higher multiple? I would think debt is just a balance sheet item.
Well, think about where the cash goes. If you have a ton of debt, when silver prices spike and you make extra money, a big chunk of that money goes to the bank to pay interest or principal. It doesn't benefit the shareholder directly. It's just servicing the past.
Right, it's dead money from an investor's perspective. It's cleaning up a mess.
Right. But if you have no debt, every extra dollar of profit is unencumbered. It can go to dividends, it can go to buybacks, it can go to finding more silver. The optionality of the company just explodes. Investors pay a premium for that freedom. They know that if silver hits something or $50, Hecla keeps all the upside.
This brings us to the comparative analysis section of the report, which I thought was fascinating. They call it the Ferrari analogy, and I love a good car analogy.
It's a bold comparison, but I think it holds water. The report compares Hecla to its closest peers, companies like Core Mining, ticker CDE, or Pan American Silver, ticker PAS.
And if you just look at the valuation metrics, those guys look like absolute bargains compared to Hecla. They're trading at maybe 35x earnings, or on a price-to-sales basis, maybe 4 to 6 times.
Meanwhile, Hecla is trading at, wait for it, 17.4 times price to sales.
That is a massive discrepancy. You could buy 3 shares of the competitors for the price of 1 Hecla share, roughly speaking. It makes Hecla look ridiculously expensive.
But the punchline of the report is this. You are buying a Ferrari for the price of a Ferrari. You don't walk into a dealership and expect a high-performance sports car to cost the same as a family sedan.
Even if the sedan gets you from point A to point B.
Exactly. With Hecla, you are paying for the performance, that 48% cash flow margin we talked about, and the brand, the U.S. domicile. Coeur and Pan American are fine companies, don't get me wrong, but they don't have that pure play U.S. leverage, and they generally have lower margins or higher jurisdictional risk.
So the market has effectively bifurcated. It's split the sector into quality and the rest.
And it has decided that quality costs extra. If you buy the cheaper stocks, you are taking on risks, operational risks, political risks, that you simply don't have with Hecla. You're buying a car that might break down on the side of the road, whereas Hecla is tuned for the racetrack.
So this brings us to the ultimate question, the verdict. We have this report in front of us. It paints a pretty rosy picture of cash flow and safety, and it justifies the premium, but we're still staring at a 104x PE. Is it actually worth it?
The report is very specific about who this stock is for. The verdict is a resounding yes, but with a major caveat. It is for growth and momentum investors.
Meaning, if you are a traditional value investor, the kind of person who reads Benjamin Graham, wears suspenders, and looks for stocks trading for pennies on the dollar, you should probably stay away.
Absolutely. A deep value investor would look at 104x earnings and have a heart attack. This trade is for investors who are betting on the direction of the silver market and want the highest performance vehicle to ride that wave. It's for people playing offense, not defense.
But we have to be honest about the risks here. We can't just paint rainbows. The report has a section on the hold argument, or the downside case. What happens if the music stops?
That's the danger of high multiples. When you are priced for perfection, any imperfection is punished severely. If silver prices stagnate, they don't even have to crash, just stop going up, that multiple will contract.
Multiple contraction. That sounds painful. That means the market decides, okay, maybe you're only worth 50x earnings, not 100x.
And if that happens, the stock price gets cut in half, even if the earnings stay the same. The report warns that HL is vulnerable to a 20 to 30% correction if the silver narrative cools off. It has a long way to fall because it has climbed so high.
That's the scary part. That's the Ferrari repair bill, if you will. But let's flip it to the buy argument, the reward. Why take that risk? Why not just buy a boring ETF?
Operating leverage, that is the key term here. Because Hecla's fixed costs are covered, and because they are so efficient, every extra dollar in the silver price flows almost entirely to the bottom line.
Let's break that down. If silver goes from $30 to $35, that's a roughly 16% increase. Does Hecla's profit only go up 16%?
No, and that's the magic. because their costs to get the silver out of the ground are relatively fixed. The lights cost the same, the labor costs the same. That extra $5 is pure profit. So a 16% move in silver might lead to a 50% or even 60% jump in cash flow.
That is why people buy miners rather than just buying the metal itself. You want that explosive leverage to the upside.
And the report argues Hecla is the best vehicle for that because of that high cash flow margin. The wider your margins, the more leverage you have.
So if you believe we are in a silver bull market, if you think 2026 is the year silver really runs, you want to be on the fastest horse. And right now, the market has clearly designated Hecla as the thoroughbred of the sector.
Even if the entry ticket is expensive, the market is saying the ticket price is justified by the potential destination.
So what does this all mean for us? For the listener trying to make sense of their own portfolio or just trying to understand how markets work, I think the core lesson here is about not judging a book or a stock by its cover.
That is the big takeaway. The 104x PE is a backward-looking distortion. It tells you what happened on the accounting books last year. It doesn't tell you about the cash flow happening right now or the production ramp-up happening tomorrow.
It's a lesson in digging deeper. The market is pricing Hecla on those rapidly accelerating future cash flows. It's looking through the windshield, not the rearview mirror.
And that raises a really provocative thought for everyone listening. When we look at high-stakes sectors like mining or even tech, we are often faced with a choice. Are we better off buying cheap problems? Stocks that look like bargains but have hair all over them. Bad jurisdictions, high debt, low margins.
Or are we better off buying expensive quality, buying the leader, even if it hurts to pay the price?
The Hecla case suggests that in this environment, the market has already made its choice. It is paying up for quality. It is paying the quality tax happily because the alternative cheap risk is just too dangerous.
And maybe, just maybe, if that super cycle kicks in, that 104x premium might actually turn out to be a bargain.
In a raging bull market, the most expensive stocks often turn out to be the biggest winners. It sounds completely counterintuitive, but history backs it up.
Well, there you have it. The next time you see a PE ratio that looks like a typo, don't just scroll past, dig a little deeper. Check the cash flow, check the map. You might find a Ferrari hiding in plain sight.
Or at least a very efficient, very safe silver mine.
Exactly. Thanks for diving in with us today. Keep learning, stay curious, and we'll see you.
Don't forget to like, share, and subscribe for more.